Step 6. Balance the balance sheet. From step 1 to step 5, we project all the accounts in both income statement and the balance sheet. Step 6 is to balance the balance sheet. The reason is all the forecasts are not based on real transaction. They are based on our assumptions. So in most cases, the balance sheet is not balanced. So we need one more step to balance the balance sheet. Otherwise, we cannot project the statement of cash flow on an unbalanced balance sheet. In the financial accounting window, if company record the real business transactions, each transaction has two or dual effect, debit and credit. So this will guarantee the accounting equation is balanced on both sides. Okay, if I can also write the accounting equation this way. Because the template we used includes all these accounts. The APIC represents additional paid-in capital. OCI represents other comprehensive income. Okay, let's see what happens if the accounting equation is not balanced. For example, if the assets is greater than the total equity and liabilities, so there will be a difference. The difference is assets subtract liabilities and all other different equity accounts. Okay, so to balance the accounting equation, we can simply subtract the difference from assets, or add the difference to the right hand side of the accounting equation. But the problem is which account we are going to adjust. That's actually the next topic. How to choose a flexible account. I will explain what's the meaning or definition of flexible account. Before that, let me show you an example of the unbalanced situation. For example, if total assets is 100, liability and equity is 80, so the difference will be positive 20. As I said, there are two different methods. One is subtract 20 from the assets. So now, after the adjustment, the total assets is 80. Or we add the difference to the right side of the equation, to liabilities and equities. So the accounting, the balance sheet is still balanced, right? So this is a circumstance when assets is greater than liability and equity. The other circumstance is when assets is less than liabilities and equity. So the difference will be negative 20. But the method is the same. Again, we subtract the difference from assets. Now assets is 80. We subtract a negative number, so actually the total assets after adjustments is 100. So accounting equation is balanced, or balance sheet is balanced, right? Or we add the difference, the negative 20, to the right side of the equation. So now both assets and liability and equities are all 80. So here the point is no matter the difference, the sign of the difference, positive or negative, when we make adjustment, we always subtract the difference from assets or add the difference to the liabilities or equity. We know there are lots of accounts in assets and liabilities and stockholders' equity. So the next topic is which account we make the adjustment. So how to choose flexible account? So flexible account actually means account is flexible. In other words, there are a lot of changes in this account for a particular company. So this account can goes up, can goes down, and there are a lot of transactions affecting this account. So we can choose the the flexible account based on the life cycle of the company. For example, the startup companies, cash marketable securities, these accounts are more flexible than others because startup companies relies on the finance, the capital from financing activities, and they need lots of cash and liquidity assets, right, for their investments and operation. For growth companies, we can use short-term and long-term debt or equity as flexible account. Because the growth companies, they build up their reputation, they generate profits and positive operating cash flow, so they can borrow money, okay? Because the lenders or the banks now believe these companies can pay their principals and interest. For a mature company, usually we use dividends or share repurchase accounts, for example, treasury stock, as flexible accounts, because these mature companies, they pay lots of dividends or they repurchase lots of shares, right? So there are a lot of changes for these mature firms. Okay, so that's the basic, approach to pick the proper flexible accounts. The example of the Pepsi actually use the treasury stock or the share repurchase because we know Pepsi is a mature firm, right? And also the template, if you see the template is designed to use treasury stock as a flexible account. But for different companies, we should make an adjustment. Okay, let's keep working on the example I use for the step 1 to step 5. And to check whether the accounting equation is or the balance sheet is balanced or not, we take a look at this row. Check figure. So all the numbers here should be 0, right? Before I balance the accounting equation or the balance sheet, the numbers here are all 0, right? The reason is because the Excel has already, balanced for you because that's the design of the template, right? But actually, the balance sheet is not balanced. Let's first check this number. This number actually is to calculate the difference between assets, the left-hand side of account equation, and the liabilities, stockholders' equity, on the right-hand side of the accounting equation. If I click, you can see the formula of this cell. So the E169 is total assets. Right. So it subtracts all the numbers on the left-hand side or right-hand side of accounting equation. The first one is the liability, total liability, E216. The next one, 221, is preferred stock. 225 is common stock and additional paid-in capital. Okay. For the retained earnings, here is a prior year balance of retained earnings. But we are supposed to use the current year, right? But actually, these three, from D228, that's prior year balance of retained earnings, actually it add E93, which is net income attributable to the common equity holders. And E261 is a dividend. So these three is the ending balance of retained earnings. The next one is accumulated other comprehensive income, 261. The next one is treasury stock. Again, you will find we use prior year balance, right? But actually there's an adjustment, 240, which is repurchase of this, right, this period. Right, so the beginning balance of treasury stock plus the repurchase of shares. So it's ending balance of treasury stock. The last one is non-controlling interest, right, 240. And this is 266 is share repurchased. Okay, so this is a formula to test whether the forecast balance sheet is balanced or not. Actually, as I said, in most time, the balance sheet is not balanced. So we should make the adjustments. Because the Excel use the treasury stock as a flexible accounts. Okay. Actually, see the difference is for a year plus 1, 6,604, because the real repurchase is 0, right? Or forecast repurchase is 0, and we know this number shows the difference between assets and liability and the stockholders' equity, right? And we choose the treasury stock treasury stock as the flexible account. See, this number is just same as the adjustment, right? So we actually add the adjustments to these accounts. So that's why this row are all 0. Okay, so the balance of treasury stock is the balance after adjustments. That's why the accounting equation is balanced. For Pepsi, it's okay. We choose treasury stock as a flexible account. Right now, we are using Apple. You will find if we keep using the treasury stock as flexible account, there's a problem because prior years are all 0. There's no reason to adjust these accounts, right? To have some balance on this account. So we should choose another account as the flexible account. What account is suitable, right? So based on this part, okay, So I personally use retained earnings as a flexible accounts. Okay? Because companies, when they make profits, the retained earnings usually increase. When they pay dividends, the retained earnings decrease. When they incur loss, right, the retained earnings also decrease. So this account is quite flexible. So I should make some changes to this spreadsheet. Okay, if I delete all these adjustments, clear the contents, see what happens. All the treasury accounts are zero, right? If there is no adjustments, the accounting equation is now balanced. These amounts are just equals to what? The difference on both sides of the accounting equation. Okay, to save time, I just make the changes in the background. I just show you what changes I make. Okay, first I change the title from treasury stock to additional dividends. Okay, so that means I choose the treasury or the retained earnings as the flexible account. See, I change all the treasury stock balance to zero, so there is no adjustments to this account. And the adjustments will be made to retained earnings. Okay, and first we copy the difference. See, if I click this cell, it just reference to 251, right? 251 is just the difference between on both sides of account equation, and that's the amount of adjustment we are going to make. Okay, so this row is the same as this row. And as we know, as I said, if we make adjustments to retained earnings, so we should always add the difference. Right? So I change the retained earnings. Originally it is the beginning balance of retained earnings and net income attributable to common shareholders, subtract dividends, and I make the adjustment. Okay, E229 is adjustments. So after this, and don't forget, you should apply the adjustment to all the 5 years, right? So what do you find? Yes, the adjustments, the difference is adjusted to account retained earnings. After this adjustment, the accounting equation is balanced. Okay, so you can depends on your companies and at what stage of their life cycle you can pick the flexible accounts you prefer. But for this class, I encourage you to use either treasury stock or retained earnings.